While we're often told uncertainty is the only certainty, today the market started to feel more certain about the rotation we're seeing. And once again, small caps outperformed as the rotation continues out of the mega caps. And despite hotter than expected retail sales numbers, small caps took charge early and continued the rally throughout the day. So should we be worried about the hotter than expected retail sales numbers? And what does it mean for the economy and the stock market? Today, we're going to talk about that along with how to generate alpha in an environment that isn't ruled by big tech stocks. The reason why you and me as investors choose to pick individual stocks is to beat the S&P 500, and today I'm going to show you where to put your bets for the best returns in the next 12 months. And of course, we have to talk about the IWM. All-time highs is closing in after a blockbuster rally. But will the rally continue, or is it time for a breather? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of green, a lot of bright green. Not that much red, mostly concentrated in the big names. But if we actually just do a deep dive here into semiconductors, we can see that a size rotation is certainly underway. We are rotating out of the mega caps today into, well, the rest of the market. We can see stuff like Nvidia down 1.1881%, AVGO down 1.5%, AMD down 1.25%, but then stuff like Texas Instruments, Qualcomm, ADI, NXPI, equipment manufacturers, these were all green on the day, so definitely a size rotation, even intra-sector. But we saw stuff like Microsoft down 0.93%, Apple was flat today, Google and Meta were down 1.32%, but the rest of comm services very, very green. Tesla gained, Amazon gained, industrials were very green. It was green across the board today. It really was a very, very strong rally. And we saw a very clear rotation out of technology and into everything else. Tech was down 0.3%. You can actually see despite the red days in both Google and Meta, comm services, the rest of the sector stepped up in a big way, up 0.3%. That is kind of crazy. But the two tech sectors of the S&P 500 were the two worst performing sectors today, and we were rotating into everything else. The best performing sector was industrials. We're going to talk about why a little later in the macro portion of the video. We talk about how we're seeing a manufacturing recovery, a restocking cycle is underway, and this is what the market is probably looking at and pricing in for industrials. But it wasn't just industrials, materials, consumer discretionary, healthcare, financials, and real estate. All of these names were up 1 to 1.9% here today. And it was a mix of everything. I mean, really, it was just a rotation out of tech and really into everything else. I mean, stuff like discretionary, that's a cyclical sector. Healthcare, that's a defensive sector. Real estate is a rate sensitive sector. Materials is a commodity driven sector. So we were really rotating out of tech into everything else. But it wasn't just the large caps. We saw a violent rally in smalls. Small growth was up 3.1%. Small value up 3.7%. Small core was up 3.4%. And it was really a rotation out of large growth, right? Because we saw core actually had net inflows today up 0.6%. Large value up 1.5%. And yesterday we said, okay, this is probably a size rotation, and we are starting to see this taking shape, and it's looking like a size and value rotation out of growth into the rest of the market, which the market duly needs. And the truth is, excluding growth, the rest of the market from large, small cap, mid cap, value, and core look very, very attractive from a valuation standpoint, both relative and on an absolute basis. But what's crazy that despite the momentum we've actually saw in the large caps, growth as a whole was actually just flat for the day. So it actually didn't lose. It was just flat for the day, up 0.0%. So we definitely are seeing a stellar rally driven and led by small caps, but mid caps in the fold as well. And large cap value, if you're in the right sectors, in the right names, large cap value is participating. And you're looking stuff like materials and energy. These names are large value names and they are performing really, really well. But let's talk a bit about small caps, because the momentum we're seeing right now is not unprecedented. A blast of small caps could have the bull smiling. This is Russell 2000 up 1% or more in 4 straight days. When did this happen? This happened on several occasions, as you can see right here. It just triggered this trade. 12-month average returns 25.3%, median 16.5%. You can see 6-month returns 13.7%, 3-month returns 3.1%, and 1-month returns 4.2%. Man, this should just be like 1-day returns. because we're seeing exceptional rallies in small caps everywhere. And in fact, the two ETFs I told you guys to buy, the small cap cash cows 100 is up 3.9% today, and the small cap quality up 3.8% today. Both of these actually outperform the IWM, which is the benchmark. And I think this rally is going to continue. I said right before the small cap rally started, and I've been championing small caps, especially small cap quality, for the better part of a year now. I said cash cows are going to get to $50. I did not give my price targets here on the small cap quality ETF, but the cash cows should go to $50 undoubtedly. The rally is underway, the rotation is underway, and as long as earnings holds up for the next 5 to 6 quarters, I think we're going to see big move in small caps back to all-time highs for the IWM. And this right here is the IWM. And when you look at this right now, this looks like a textbook Wyckoff accumulation zone. And now we're actually breaking out. Expect to go back to all-time highs here in the IWM. Now, this is the weekly chart. Very, very strong candle. So far for the week, up 5.38%. On the back of last week, up 6.11%. Very, very strong momentum. The IWM was up 3.41% today. And guys, you know, the CAF index and the small cap quality index actually did outperform the IWM here today, which is actually kind of nuts when you think about it. You can see right here, this orange line is the CAF index. This is the IWM. This is the benchmark. And I do think we're going to continue to see this over the next 3 to 6 months. I don't think we're going to get 3 to 4% gains every single day for the next 3 to 6 months, but we should see outperformance against the IWM in the CAF index, and the IWM against some of the large names like the Nasdaq 100 was up 0.06%. That is actually still a gain. I wonder what the equal weight Nasdaq 100 put up today. Let's have a look. And you can see the equal weight Nasdaq was up 0.84%. So really, even in these mega cap names, it was really just a rotation out of the mega caps, because the Nasdaq equal weight actually gained on the day up 0.84%. That is very, very strong. And that is literally a large cap ETF of just 100 stocks. 7 stocks make up a large majority of it. So very strong to see that performance in stuff like the Nasdaq 100. The S&P 500 actually did a really solid day today. It was up 0.64%. Very strong momentum we're seeing here in the S&P 500. And something I did tell you guys yesterday was that the gamma flip moved up to the 5,700, which means that's where we're going to go for the S&P 500. We're going to keep buying dips, selling rips to the 5,700 area. And that's a new all-time closing high for the S&P 500. And expect us to just rally into the rest of the week, into the rest of next week to the 5,700 area, because that's where the core gamma resistance is. And again, like I said, if we are to pull back, we should find support here at the 55.47. That is the gamma flip zone. But I think we're going to get to 5,700 first before we do see any type of a pullback, and then the rally should continue higher. My expectations for the end of the year is 5,800, 5,900. I think we should see the S&P 500 there. But on a bull case, 6,000 is not out the picture. So buy dips, sell rips. Guys, remember how bearish everybody was right here during April, May? Look at where we are right now. Absolutely crazy. And I said buy the dip right here. I was a huge bull. I said buy, 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 buy. And this is where we are right now. From these lows, on a peak to trough basis, we're up 14.57%. Inconsequential when you look at the rally ever since. Now, the reason why smalls did so well today had to do with yields. Yields keep falling down 1.72%. The 10-year yield, the 30-year yield down 1.5%. Bonds gained as a result. TLT still hovering around this area right here. Going to be really, really hard to break this 94.60, 95 area. But the second we do, we're going to see an imminent rally supported by rate cuts. And the market is now 100% certain on rate cuts. I was looking at Fed probabilities, something like a 91% chance of a September cut after the retail sales numbers, which did come in a little bit more firmer than expected. So retail sales in aggregate actually came in at the consensus expectation of 0%, as you can see right here. But what was a little bit concerning was retail sales ex autos came in at 0.4%. The expectation was 0.1%, but the market brushed off these figures and continued moving higher. Gold is also telling you that rate cuts are coming. Gold is up 1.93% at all-time highs. It's closing at that level. Very, very strong chart here for gold. This is the year-to-date chart. We actually pull up on a percentage basis, up 19.54%. I believe that's actually better than the S&P 500, or around the same. Let's actually have a look at what the SPX return is relative to gold this year. Yeah, roughly the same. Inconsequential if you dive into the decimal points. Silver roughly did the same. Now, not quite at the highs we made this year, but up 1.87% today. And it actually has outperformed gold. It's actually up 31%, complete outperformance against gold. I do think silver's going higher. My position is in. I'm right here at the 28.50 level. Very, very strong. And crude does look like it actually wants to move lower. But again, you know, I say this pretty much every single video. $77 if we are to pull back is probably where we'll find support, and you know, upside is probably limited to the $86-87 area right there. We can see a little bit of an issue if we do go higher, but I think if the lower crude prices go, I don't think that's necessarily going to be a bad thing, especially for the broader economy and the inflation picture with regards to PCE, CPI. Now, you know the figures for the Russell, you know our targets for the S&P 500. We're looking to 5,700. We're buying dips, selling rips to that area into Friday's OPEX, and then we enter the window of weakness. With regards to the IWM, I think we can see and can expect a little bit of a breather. That can come in just consolidation over the next couple of days. Can see a bit of a pullback. Ultimately, when it comes to the IWM, you know, I am looking at probably our first target of maybe 230, 228, probably around this level in the next couple of weeks. I think we're going to have a blistering rally back to all-time highs. So let's aim for the 230 level, and then we can aim for the 235 level, and then all-time high. So 230 is the target right now. Let's say maybe over the next month. The Russell does tend to suffer in the window of weakness. If you actually like look at the Russell, you'll see like this is run up into OPEX, and this is the window of weakness. Similar right here, window of weakness. So when the window of weakness does come, we could see a little bit of downward momentum here in the Russell, but I think we should actually make a higher low and then just continue the rally in the Russell. So any dip we do get is just going to be a buy the dip opportunity. But with the strength we're seeing right now, if we don't get a dip and we just continue, don't be surprised right there. Targets 230 for the Russell 2000 and 5,700 for the S&P 500. Now guys, let's talk a bit about sentiment. Now an indicator we look at every single week without fail is BOFA's bull bear indicator. I quite like this indicator because it's been very, very accurate. Now I just wanted to just do a bit of a deep dive into how this indicator has performed. Just because we do look at it, I thought it'd be very interesting. Now you can see here we have the buy side and the sell side, and you guys know what this is. Pretty much if this is in the sell side or in this red area, approaching overbought, and this side the opposite, oversold. Essentially, you want to buy in this area and sell equities in this area. And you can see here in February 2018, we were at the 9 right here. This was when the market was super, super bullish. Right before the COVID crash, Jan 2020, we were at the 7.5 area. And this was actually a pretty bullish time period. I remember right before COVID, before the massive crash, you know, the sentiment was, you know, buy equities. Equities look really, really good. But then likewise on the other side, October 2022, the October lows, this was signaling a massive, massive buy move. And similarly, October 2023, the October lows last year, the S&P 500 had pulled back about 12% from its highs it made in July. We were at 1.9. We were at about this range right here. It was a great buy signal, and this has been a very accurate indicator, not just in recent history, but throughout history. Now, this indicator does actually hit the 0 quite often, but when it does get below the 2 line, when we do get below the 0 line, it's a great opportunity to buy. And likewise, when we get above the 8 line, and I would actually say when we get above this 7 line right here, we can actually see a little bit of a pullback in the market, but ultimately it is this 8 line right here. Currently, the indicator is at about 6.3, so there is still room left to run to that 7-8 region and to get to the extreme bullish side, which it rarely does. With that in mind, what are the likely outcomes for the S&P 500? And this is S&P 500 past performance from July 15th to December 31st after a turn of the year hat trick. Now, a turn of the year hat trick is when we've had December, January and February in positive. This trade has triggered here in 2024, and we actually get very, very bullish returns. 23 wins, 2 losses, average return in the 6-month period, 7.53%. But I actually want to dive a little bit deeper. I want to look at potential buy opportunities, because we could see here that from the 8th of the 3rd to the 10th of the 3rd, so pretty much from August 8th onwards, we can actually see a dip buying opportunity in this 1 week period right here. We normally can actually see a drawdown of about 0.96, let's call it 1%, 8 wins, 17 losses. So it seems like this early August, maybe even late July period tends to be a little bit bearish after a very solid July. And this would be an opportunity for us to buy the dip into the end of the year, because it does look like after this initial period right here, we don't actually get dip buying opportunities until early September, mid-October. And then from there, we actually just continue the rally in what is exceptional returns from November onwards. 1.60%, 1.63%, 20 wins, 5 losses, 1.21% here in October, November, December. and a full year return like I just told you guys. So the market's looking very bullish when you look at stats like these, but a lot is going to come down to earnings. Now, Q2 earnings, we're kind of in the thick of it. We're in this week right here. About 11% of S&P 500 companies are reporting this week, and then next week it ramps up in a very big way. And then we have 2 weeks of very big earnings, the big tech names, the big com services names, the big discretionary names, and then from there it does taper off. So this week, next week, and the week after next, very big for earnings. But as of right now, we do have quite a number of names that did report today. Progressive, UnitedHealth, we're going to dive into them a little more. We also had Bank of America, Interactive Brokers after the close. And then for the rest of the week, we have ASML, we're going to tackle them, Discover Financial, United Airlines, TSMC, Netflix, some very big names in each sector right here, particularly for media and entertainment. Netflix is a big dog, and TSM on the semiconductor space, and then American Express here on Friday. Discover Financial and American Express is kind of going to give us a barometer for what credit services is going to look like: Visa, MasterCard, PayPal. But let's dive into UnitedHealth. UnitedHealth Group earnings, a very good earnings here. They beat on EPS, beat on revenue. Expectation was $6.67. They smashed it as well as revenue. I believe these figures are about 6 to 7% growth year over year on the revenue and EPS side. Management also reaffirmed guidance right here. The street was expecting $27.59. Management came out, said $27.50 to $28. The lower end of their guidance was at the street's estimate. This was actually really good. In my opinion, I actually saw this as a tiny bit of a raise, but call it reaffirming 2024 guidance. But the stock was down 2.2% here in pre-market. This is recorded pre-market, and anything could change during the day. But I'm going to be honest, I thought these earnings were good. I thought this was good. What was a little shady about the guidance was they included non-recurring items. They said, this is our guidance excluding non-recurring items, right? The problem is they have a ton of recurring lawsuits that's not factored into this guidance and the earnings overall that they're going to cop later on down the year. And I think that's why the market was selling them down here in the pre-market. But you know what? In the here and now, or the second quarter, I thought the earnings were good. There wasn't anything to poke at. Free cash flow was good. The overall fundamentals of the company was on the up and up. And I actually think the stock will probably rally once it consolidates. The downside we're seeing here in the pre-market will be very short-lived. Now, taking a more macro view of earnings, this is EPS estimates for the S&P 500. And it's very clear to see the current trend. Now, this blue line right here is 2024. This black line right here is 2025 earnings estimates. And this gray line right here is next 12 months earnings estimates. So you can see next 12 months earnings estimates are actually moving higher. And that is because 2025 earnings estimates are looking very, very strong, very robust. We actually seen mild up revisions. Is for those of you that don't know, earnings revisions technically get revised anywhere from 8 to 12% to the downside leading up to earnings season. So to actually see the last probably 9 to 12 months of flat to sideways earnings revisions is really, really bullish. That's a bullish thing. Typically, earnings look like this. In fact, the historical average probably is something more like that. 2024 earnings have been very robust, so too has 2025 earnings. And this has resulted in the next 12-month earnings pretty much moving to the upside. This is year-over-year growth, despite the trend you're seeing here in 2024 earnings. And for those of you that are bearish, there's a couple of things that you need to see happen to the earnings picture for a pullback to actually materially occur. You want to see 2025 earnings do this in a very big way, and you want to see next 12-month earnings trade sideways or do this. If any one of those two things happens, then we can get a sell-off in the S&P 500. But as long as earnings are as robust as they are right now, and as long as earnings revisions hold up as they are right now, continue to expect higher prices in the S&P 500. Now, with that in mind, what exactly does this mean for the S&P 500 and our ability as investors and traders to generate alpha? Now, according to analysts, based on the current earnings trend I just showed you, they expect the bottom-up target price of the S&P 500 to be 7.6% higher in the next 12 months versus the closing price here today. Now, this is the S&P 500. If you truly want to generate alpha above the S&P 500, I would probably look at these sectors right here, particularly energy. A huge majority of analysts see the energy sector rising 17.5% from where it currently is. In second, third, and fourth place, they see the material sector industrials, and healthcare. And it's very obvious to see that analysts expect commodity-driven sectors to do very, very well. On the flip side, they see information tech being the worst performing sector over the next 12 months, only to gain 4.2%, then utilities, then comm services, then discretionary, and the S&P 500 in the bottom end of the barrel. In fact, they see real estate, financials, staples, and healthcare all outperforming the S&P 500. So it seems that buying the index won't necessarily be the best course of action in the next 12 months, especially if stuff like infotech and comm services are to provide lackluster returns against every other sector. Now let's dive into some macros. So something we look at a lot on this channel is GDP. Or we look at US GDP a lot. We don't really dive into GDP for the rest of the world, the rest of the market, and consensus expectations. Now, this is 2024 GDP forecasts for the US, but we also have China, the global market, the global economy, as well as the Euro area. The US consensus figures is at about 2.3 to 2.5%. The Euro area has seen massive down revisions here in GDP, a slight uptick recently, but sitting just under the 1% mark here at 0.8, 0.7. So growth in the European market not looking that great, but we'll see if this continues to accelerate to the upside. Regardless of Europe, we've seen a massive uptick in global GDP though, things looking very upbeat in the global economy, and the same is true here with China at about 4.9 and close to 5%. That's the Bloomberg consensus as well as Goldman Sachs consensus. So growth across the board looking fairly robust, except in Europe, a lot left to be desired. Now, let's dig a bit deeper into the US economy, because that's where I have most of my money. That's where probably you have most of your money. And this is US rail freight carloads versus the ISM PMIs. And essentially what this index is telling us right here is that rail freight carloads continue to rise, pointing to a manufacturing recovery. At the same time, we're seeing the new orders and inventories ratio jumped in June, reversing the year-to-date downtrend we were currently seeing in the new orders inventories ratio, and essentially improving order trends combined with a continued decline in inventory levels. That's what we're seeing. This suggests the destocking cycle is moderating. This also points to the fact that we are probably on the cusp of a manufacturing recovery. And if we get a manufacturing recovery, expect Europe's GDP to accelerate in a very big way, because a lot of Europe's economy is dependent on manufacturing. Look at stuff like Volkswagen, BMW, Porsche, Mercedes-Benz. The economy is heavily dependent on manufacturing production. And while we are expected to see a manufacturing recovery over the next 12 months, what we are seeing in the year now with regards to employment is moderating employment. This is non-farm payrolls as well as private payrolls. They are pulling back. But to me, this looks like normalization, because these dotted lines right here is the 2019 or the pre-COVID average. So we're seeing moderation in private payrolls, moderation in NFP, back to its historical average. If we could sort of see like consolidation, I guess at this point, that would be healthy. And then we can say the labor market is back in balance. And guys, at the end of the day, when I do my deep dives into macro is really hard. It's really hard to get right, but sometimes it's also really simple. And what the rate market is telling us right now is that it's pricing in the Fed bottoming out at 3.5% here in 2026. Look, inflation is currently at 3%. On some figures, you could see 2.7, maybe 2.8% if you look at the PCE version, but inflation is currently around the 3% mark. The bond market isn't pricing in a recession right now. This is not the bond market pricing in a recession. It's on its way to pricing in the perfect soft landing. Even then, these rates right here seem a little strong given the strong positive real yields we're seeing right now and the disinflationary landscape. One economic slip up, guys, and bonds absolutely rip, yields fall, the Fed cuts, and that could definitely come from a moderating labor market, as we are seeing right here. Maybe we get below the 2019 pre-COVID averages, the Fed freaks out, something like that. So you have to pay attention to all of these macro factors. And the best way to do that is to subscribe to my channel, because I do the best macro breakdown here on YouTube. Now, looking at data in the week ahead, guys. So today we had retail sales. Tomorrow, the big ones are going to be building permits, housing starts. We're also going to pay attention to some of the Fed speakers, industrial production. That's really it. And then for the rest of the week, we have initial jobless claims, the leading indicators, and then a whole bunch of Fed speakers here on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.